Welcome back. Today we are talking about a company that definitely belongs on your watch list, in my opinion. It is a small position for me, but probably will grow, especially if the price drops in the next couple of weeks or so. But anyway, it is Wabash National Corporation. They're about $1 billion company. They are based out of the U.S. and they manufacture trailers that go on the back of like 18-wheelers and stuff. Some refrigerated van trailers, but if you're just driving on the interstate, you'll see their logo on the back of certain trailers. So anyway, I found them, I think, by doing a little bit of reverse engineering on Atcore, where I tried to do screeners that I knew Atcore would fit and then look at what other companies fit in that screener, and this was one of them. Something like, low price to free cash flow and good return on assets, I think is what it was. Something similar to the magic formula, but I had some other criteria as well, like share buybacks, that sort of thing. But anyway, I'm going to run through the financials. We may look at the PowerPoint, I'm not sure yet, and then look at the earnings call a little bit, and then we'll do a DCF at the end. So let's get started. First up, total revenue. So for this one, I just want to point out how cyclical it is. I mean, it is steadily going up, which is good to know, but it does go through these, drops every once in a while. And so, it's a cyclical company. I mean, look what happened to the revenue during the '08 issue, But anyway, to really highlight that, I want to show you, let's see, their operating income. Because you see, like, even at the beginning of COVID and then in '08, they were actually losing money from an operating income standpoint. So that's just the nature of the beast with some cyclical companies. But one thing I really want to do whenever you're looking at a cyclical company is make sure that the debt's not enormous to where, if they hit a downturn like this, there's a risk of bankruptcy, So in their case, and just in general, what I always like to look at is, what is your interest expense, your net interest, and then we'll look at the balance sheet as well, compared to your operating income. So where is interest? Yep, okay, interest expense. Interest expense right now is about $5 million per quarter, and you can see that since 2020, they've really worked that down, and I think they're at a point where they feel comfortable, where management feels comfortable. They've kind of stopped paying down debt. They're focusing now on other ways to spend money to return value to shareholders or grow the business, like we'll talk about. But that is about, $5 million a quarter. And like I said, I like to look at it as a percentage. So if you're making 40 a quarter, like up here, then 5 over 40 would be about 12.5% of your operating income. So personally, this figure, right, the lower the better. I think 15 is kind of a ceiling for me. Maybe 20% is a ceiling, depending on the company, but you don't want it to be super high, and the lower the better. So 12 is kind of in the gray area for me, but if management has declared that they feel comfortable with the debt and it's in the decent area, I feel okay with that as well. So anyway, I think from a balance sheet perspective, they're all right. And I'll jump to the balance sheet real quick to show you some things. The first one, look at this, ordinary shares. So since 2014, look what the share count's done. Down from 70 million shares to close to 45. I think it's 45 right now, right? 45 million shares, yeah. So you can see what happened as a result of the '08 issue is that they had to do some big dilution to save themselves. But since then, they've just been paying down or buying back shares and reducing that share count. Just a general look at the balance sheet. So I like to look at net tangible assets, or another way to look at it's tangible book value. I think they're roughly the same thing. We'll check that here. So tangible book value, $250 million, and then let me look at net tangible assets and see what that is. Yeah, it's pretty much the same graph. Okay, so basically what it is it's your tangible assets, so things that are physical items, not things like goodwill and intangible assets, minus all your liabilities. That's a rough definition. And I love to see this growing. I think it's a great sign. Obviously, it's scary to see how erratic this graph is, right? Because it seems like it could just crash anytime that there's a down part in the market. And, net tangible assets bouncing around can also be caused from a lot of change in, what's a tangible asset, or if they did a bunch of goodwill or something like that. So I'll pull up total equity real quick just to show you what that's done. And it's not nearly as erratic. And then more importantly, debt to equity. So this is going to be all your liabilities divided by all your equity, and you can see that we're between 1 and 2 now, and they've worked it down, and they're kind of stabilizing. So anyway, I don't think the balance sheet is like an A plus, but I think it's solid. Like that's how I'd like a B, let's say. All right, operating cash flow. So I have gotten to the point in investing where I'm pretty much the only thing I care about is the cash flow statement. The balance sheet, just like a quick check, but really what matters to me is the cash flow statement. And specifically, I just think that it really helps you understand the story of the company, like exactly what's going on, like the cash that's coming in through operating cash, and then what they're doing with that cash, whether they're spending it to return value to shareholders through financing cash flow or doing a lot of CapEx, investing, that sort of thing. So let's start with the operating cash flow. They are consistently, I know it's kind of like reading sheep guts here, but I think that you could definitely tell that there's a little bit of that they're consistently growing, like the midpoint's growing on this trajectory. I think it'd be optimistic to say 60 million a quarter. I think that's kind of actually way too optimistic. I think 40 million a quarter moving forward is a pretty good assumption. So I'm going to go with that. So 40 million a quarter, and I'm going to use that later in my valuation. You'll see, that's a 30. So 40 million a quarter, that's 160 million a year. Okay, so then the question is, that's operating cash flow. To get to free cash flow, which is what I want for my valuation, how much are they CapExing? Before I do that, though, real quick, let's look at stock-based compensation. I like to make sure this isn't ridiculous. So it's about 3 to 3.5. So less than 10%, right? Because I did operating cash flow as 40, but that's still a little bit on the higher end too. I kind of like that under 5, but it is what it is. It's not in the like no-go zone, but it's not, again, solid, not a A+. Anyway, okay, I said I was going to go to capital expenditure, so let me do that. All right, CapEx. So this at first glance kind of scares me because it's a company that I said was making about $40 million a quarter in operating cash flow, and they're spending like 25 to 30 per quarter recently on CapEx. And it reminds me of that statement Charlie Munger made about like the used or rental equipment business where the guy said all of his profits were just turned into capital expenditures, right? So I get very scared whenever I see high CapEx. But in this instance, what I did was actually do a little bit of research, right? And so I'm going to pull something up for you real quick. So we're back to Seeking Alpha. And once again, if you want a Seeking Alpha membership, I have a discount code that really helps the channel. They pay a great commission, so you can click on that. I think it'll be like the first or second link. Anyway, they have all the transcripts, which I love. Okay, so here we go. Earnings call transcript from Q1. And I look at a lot of companies, and I think it's very important to read these transcripts, especially the Q&A session. However, it takes a lot of time, right? So what I started doing was literally copying this, like taking the transcript, copying it, and then putting it in ChatGPT, which is like, it's awesome. Let me show you. So I'm going to pull up ChatGPT. Okay, so I just literally said, summarize this earnings call. And this is me pasting what I pasted, and it's like having this super great assistant read it and give you a summary. Okay, and this is ChatGPT 4. I pay for the expensive it's only $20 a month, but anyway, I think it's definitely worth it compared to 3.5. All right, so here's the summary. It gives me some key points, nothing crazy. But what I love about it is that I can have a conversation with it. So I said, I asked it, okay, what do they mention about the elevated capital investments? All right. And ChatGPT comes back and says, it gives me a big breakdown, but this is the key point. These investments are beyond the annual maintenance CapEx spend of 20 to 25 million. All right, and then says that the elevated investments are aimed at supporting organic growth initiatives. Okay, so that's awesome, right? So let's keep this number in mind, 20 to 25. Let's say 25 million is required. All right, so you need 25 million a year, which means that the other amount of money is not really going to be subtracted in my version of free cash flow, right? It's kind of more like an investment that the company's making. So I'm going to go back to the cash flow statement and kind of describe what I mean. All right, so what I'm trying to say is that even though the CapEx is elevated per quarter, it really should be down here, right, about six per quarter. All of this is extra money to hopefully grow the business in the future. Okay, so what have they been spending? Let's just look at it. The average of the last 8 quarters has been 20.5 million a quarter. So 20.5 times 4, 82 million. Okay, so they've been spending 82 million a quarter. Not a quarter, a year, 82 million a year. And just like, so that we're on the same page, if you just looked at this on a price to free cash flow, you would do 160 divide minus 82, and you'd say $78 million of free cash flow selling for $1 billion. So that's like an 8% yield. Not that good, right? And you might pass on it because it seems like a solid business, not super great, and it's selling maybe a little bit at fair value at this free cash flow multiple, right? However, what happens whenever you subtract, instead of minus 82, you do 160 minus 25, which they say is standard CapEx. Now you're at $135 million of free cash flow on a $1 billion company. So you're looking at double-digit yield, all right, on a company that's also buying back shares. So that's pretty impressive to me. The downside is that there's a lot riding on these investments really paying off, right? So what I want to do now, though, is use that $135 million of free cash flow, adjusted free cash flow, if you will, to kind of come up with a fair value. All right, so let's go to DCF. All right, so my DCF, let's see, I said $135 million of free cash flow. I want to get that to per share. So if you remember earlier, I said there was about $45 million shares outstanding. So 135 divided by 45 gets me into dollars per share. Look at that. Look how that works out. Exactly 3. All right, $3 a share in adjusted free cash flow. I need a growth rate. Okay, so 5-year growth. How do I do that? I'm going to come at it from 2 different ways, right? I think I'm going to assume that they're going to be getting some return on that extra CapEx that they're doing. And then I'm going to look at the share repurchases. Okay, so let's do that extra CapEx first. So remember, they were spending 82 million the last, on average, 80 million a year or so. Maintenance is 25, which means that their investment CapEx, let's say, is 57 million. I think it's safe to assume that they'll get a 10% return on that money. So multiply that by 0.1 to get to $5.7 million. So what is $5.7 million? What kind of growth rate does that translate to? So the way I'm going to do that is you do 5.7 divided by 135, which 135 was the free cash flow we calculated. So this is like the incremental cash flow coming from their investments. It's all assumptions, right? But this is just me trying to get to a growth rate, okay? So 4%. So 4% from organic growth, let's say. I think that's a fair assumption. I'd hope they do better than that, honestly. That would be, but we'll see. Well, I hope that they do better than 4% whenever you factor in just general market growth, right? All right, so 4%, and then I want to go to the share repurchases and get the other end of the growth equation. So to do that, I'm going back to the balance sheet, and I'm going to look at ordinary shares number and go down here and show you that they were at 45, or they're at 45 now. 1 year ago, they were at 47. Okay, 47.6 down to 45.1. So 45.1 divided by 47.6 minus 1. All right, so that's about a 5% growth from share repurchases, okay? So I'm going to go back to the DCF. Okay, so 5% from share repurchases, 4% from the organic growth. I'm going to say that's a 5-year growth of 9%, all right? Perpetual growth, I'm going to go lower. I just think you should always go like 1, 2, or 3 here. I'm going to go 3, all right? And I get a net present value of just shy of $30 a share, okay? Which means right now they're trading at about, let's see, 75% of fair value, okay? So my margin of safety is usually 2/3, which puts my target entry right at $20 a share. I have made this mistake before where I've waited for things to get a little bit cheaper and just really regretted it. Williams-Sonoma comes to mind. Crocs, both of those have like doubled whenever I almost bought. And so this one is a small position for me. If something ever gets to like my margin of safety 2/3 on a 15% discount rate, I'm usually pretty heavy into it by that point, right? As it gets closer to that, I'm probably adding. But that's just my opinion. I think that this is a solid company. I think it's a pretty straightforward company, like easy to understand. You can like see the products if you live in the United States, just like driving on the interstate and everything. And I don't know, it's just the kind of company I like, right? So anyway, hope you enjoyed it. Like, comment, subscribe. I'll see you next time.